This is usually the moment people hesitate. Policy loans sound confusing. Questions like, am I borrowing my own money? Does the money stop growing? What about the interest payments? If this part feels uncomfortable, that's normal. Most people have never had this explained to them clearly. You are not withdrawing your money, cashing out your policy, or interrupting the policy itself. Nothing's being taken out of the account. Why do people assume that access to money automatically means losing growth? Your policy stays intact. The insurance company lends you the money, and your policy is used as collateral. So your cash value doesn't disappear. The policy does not get smaller when you take a loan. This is a very important point. Have you ever noticed that banks don't sell their assets when they need money? They borrow against them. Policy growth is based on the policy, how much money you've put into it, not the loan. The loan is separate. There's two parallel tracks. The policy continues to grow, and the loan exists until you repay it. What if accessing money didn't require stopping its growth? Yes, policy loans do have interest, and that's transparent, and that's real. The key question isn't if there's interest, it's where does that interest go? Anytime you borrow money, someone earns interest. But who usually benefits from that? Interest on a policy loan does not go straight back into your pocket. It flows into the participating pool of the participating whole life insurance contracts. And that pool supports guarantees, supports dividends, and supports long-term policy growth. So this is not paying interest to yourself. It's paying interest into a system that you participate in. With traditional loans, interest is pure leakage. It leaves your financial life forever. With participating policy loans, interest recirculates. It strengthens the system that you're a part of. What's the long-term difference between money that leaks out and money that stays inside your own system? Here's what most people never calculate. Over a lifetime, mortgages, cars, credit cards, lines of credit, interest can consume roughly 35 to 50% of after-tax dollars on those payments. What does that mean? If a third of your after-tax income is quietly flowing to the banks, becoming your own banker is not about avoiding interest. Interest is a fact of life. It's about recapturing, redirecting, and reducing leakage. The question isn't, will I pay interest? It's where does that interest go? With this structure, you're the borrower, you're the depositor, you're the capital allocator, and you're the bank owner. You control when you borrow, how you repay, and when you repay. There's no forced schedules. That's a very important point as well. There's no market timing pressure. What changes when you stop renting the banking system and you start operating one? This isn't magic. It doesn't eliminate costs. It improves efficiency over decades. Small advantages compound over time. What would it mean if even a portion of that interest you're already paying worked for you instead of against you? This system isn't about beating loan rates, arbitrage tricks. It's about control and flexibility and long-term capital efficiency. How different would your financial decisions be if every interest payment strengthened your system instead of weakening it? This is powerful, but it's also not for everyone, and that matters. Who actually benefits from thinking this way? In the next video, I'll explain exactly who the system is for and who it's not for. Clarity beats hype, always.